Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. We've had some interesting moves here these past few weeks, but it may interest you to know, should you choose to look at it this way, that we're at roughly the same levels we were 2 weeks ago, and roughly the same levels we were 2 weeks prior to that, and then 3 weeks prior to that. There have been in that time a weekly key reversal up and a lesser outside week down. Prices have also breached and consolidated below the important 50% Fibonacci line of the March to November 21 move at 1768. But a further attempt lower was swiftly rejected 4 Mondays ago by the lower time, currently at 1730, of the big old December 20 to April 2021 bullish shift pitchfork. This caused prices to rise and reach up as far as the upper time, currently 1845, with a bearish May to July Andrews pitchfork before coming back down to halt just above the 50% Fibonacci line again at 1768. And between the upper time and the middle time, that middle time is currently at 1730, and interesting at the same level as the big old lower time today. It has also allowed me to draw a near-term July to August bearish shift pitchfork, which interestingly is closely allied to the bearish Andrews pitchfork, as you can see on the daily chart. This brings me to the two key points of all of this. Firstly, there has been a fractal level of indecision in this market with wide ranges but a lot of indecisive daily actions, plus two nearby bearish pitchforks countering a longer term and larger bullish pitchfork. That's the first point. We are, I suspect, relatively having indecisive swings in this market, as has been evidenced by the contrary pitchforks and daily actions in some cases, and the weekly key reversal and outside week contradicting each other. The second point is that I suspect that this might settle down a bit, but one should look very cautiously at that, as I also suspect it is a false sense of security. You see, the declining upper tines of the bearish pitchforks are moving each day closer to the lower tine of the bullish, longer-term shift pitchfork. This will, I imagine, lead to a gradual squeezing of the market, much as a toothpaste tube is squeezed into a narrower and narrower range until by the latest, which is late September, we may have an explosive move. Right now, I am unsure which way that move will be, but it will put pay to one of these forces, the bearish one or the bullish one. Ice London white sugar in Ice Europe, white sugar in London indeed. This one is perhaps not so easy to fathom as the New York contract. However, there's one clear distinct pattern, though it looks like the market is not comfortable in going to targets on it. There is a double top, Adam and Adam type, formed over June and July for primary target X in the 498 even area, and a secondary fuller target X1 in the 476 area. Late July saw the market gap down due to changeover and carry on further down, below the long moving average, currently 528.30. However, prices juddered to a halt at the same low area, around 509.5, that we saw back in May, and not far from the high seen in December last year and January this year. Indeed, there are 3 consecutive areas at 517.80, 514.5 and 509.5 that seem to be sort of breakwaters ahead of the seemingly very important support of the 50% Fibonacci line of the July 21 to July 22 move at 506.30. It is a support based on this 50% Fibonacci line that halted the fall in late July, halted the monthly key reversal down we saw last month, and turned prices back up until last week. Last week, prices peaked just before the February 2017 higher, 565, an area of resistance I granted, but not one which I would have said was outstanding. The dip last week was interesting. Below the short medium moving average, currently at 550.60, the flatlining medium moving average, currently 548.60, and the March higher, 548.70. Yet prices were stopped by the rising short moving average, currently 543.70, or so it seemed. You see, I suspect the extension of the neckline, currently at 543 even, of the August to December 2021 complex head and shoulders top may have something to do with it. I've noted that while it may not always provide definitive support or resistance, it still acts in many ways like the middle tine of a pitchfork, providing the bullish angle of attack in this instance. I'll be curious to see if this continues to be the case. One other point. The overhead February 2017 high at 565, which I did not rate especially significant, is the gateway to the changeover gap left in July between 564.40 and 588.80. Perhaps it is that rather than the February 2017 high itself that provided the recent cap, as the market showed reluctance to try and fill in that gap. No, fill in that gap just yet. Sugar white premium spread. The last few weeks since changeover have been a period of recovery until the last 2 weeks, when prices, having filled in the gap 137 even to 145 and 3/4, become undecided as to what to do. It started 2 weeks ago with the second week in a 2-week meeting lines pattern, a pattern that is traditionally seen as bearish, but which data indicators is ever so slightly bullish or even random. This was followed by last week's indecisive spinning top. So far this week, well, we seem to be back into recovery mode, but it will very much depend on where we close this week. You see, the market is currently playing with the 2013 high at 152 and 3/4. These past 2 weeks have seen that used as resistance, but so far this week, we have seen prices sell through it higher. Well, 2 things I'd like to consider. Firstly, the reason we saw the market turn back higher after the changeover is fairly obvious. It was the rising medium moving average, currently at 132 even below. This moving average has been penetrated both 5 and 4 weeks ago, and though being breached, it was not broken, with no closes or even opens underneath it. Secondly, and this is a longer term factor, is the middle time, currently 155 and 1/4, of the big old 2019 to 2021 bullish Andrews pitchfork. This had been resistance back in March and April, and then support again until the changeover, and I suspect that its bullish influence is what has caused the market to re-explore the upside. We now have resistance at 162 and 3/4, but the next significant resistance is at 164 and 3/4. That's the July 2012 and indeed the whole of 2012 high. As a final point, don't forget target X1 above at 191.5. This is a secondary and harder to reach target for the recent bullish ascending wedge pattern. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. Here comes the final bit.